Welcome to County Portal, your simple source for local government services and public records. Let's get started.
Today we're breaking down Vice President Kamala Harris's proposals for capital gains taxes and what they could mean for investors and inheritances in America. A capital gain is simply the profit you make when you sell an asset, like a stock, a bond, or a piece of real estate, for more than you originally paid for it. Currently, the U.S. tax system treats long-term capital gains, those on assets held for more than a year, very differently than regular income from a job. Most people pay a tax rate of 0%, 15%, or 20% on these gains, which is often much lower than the rates for ordinary income. The Biden-Harris administration has proposed a major change to this system, primarily aimed at the wealthiest Americans. The first and most significant proposal is to tax long-term capital gains and qualified dividends as ordinary income for individuals earning more than $1 million per year. This would be a dramatic shift. Instead of a top rate of 20% on their investment profits, these high earners would see that rate jump to the top ordinary income tax rate, which would be 39.6% under their plan. When you add the existing 3.8% net investment income tax, the total federal tax rate on capital gains for million-dollar earners could climb to over 43%. The goal here is to equalize the tax treatment of wealth and work, based on the principle that income from investments shouldn't be taxed at a lower rate than income from a salary for the very rich. The second major part of the plan targets inherited wealth by closing what's known as the stepped-up basis loophole. Here's how it currently works: if you buy a stock for $10 and it's worth $100 when you pass away, your heir inherits it with a new cost basis of $100. They can then sell it for $100 and pay zero capital gains tax on the $90 of growth that happened during your lifetime. The administration's proposal would eliminate this. Instead, death would be treated as a taxable event. The unrealized capital gains on assets would be taxed at that time, though the plan includes a significant exemption, such as the first $1 million of gains per person, or $2 million for a married couple. There would also be protections for family farms and small businesses to ensure they can be passed down to the next generation without being forced to sell. The revenue generated from these higher taxes would be used to fund various social programs, such as childcare, universal pre-K, and other parts of the administration's domestic agenda. In essence, the proposals represent a fundamental change aimed at increasing taxes on the investment gains of the wealthiest Americans to both reduce inequality and pay for new federal initiatives. Thanks for watching this breakdown of the proposed changes to capital gains taxes. If you found this explanation helpful, please hit that like button and be sure to subscribe to the channel for more clear, simple explanations of important financial and policy topics.